The starting point is we do have a very inward-looking approach to financial services in Australia. I mean, we get very, very focused, almost obsessed about what's happening within our own market, and we do tend to therefore downplay the opportunities that exist across the region. And, you know, as everyone knows in this room, and it's barely worth mentioning, but, you know, it is the engine of growth. It is where the new middle class is going to be. They are going to want more and more sophisticated services. And they are a potential source of savings that we can tap into. We made a very serious attempt back in 2006, 2007 to get, and we being both the ABA at the time, but also NAB where I was working at the time, to get us the concept of Australia as a financial services centre onto the agenda, and that's still there and talked about, but we sort of got somewhat sideswiped by a thing called the GFC coming along. But I think there are huge opportunities there. I think we need to be careful though there seems to be a tendency to think just because we are in the region that somehow these things are going to fall into our lap. We are still a long way from the region when you compare us with Singapore, Shanghai, Hong Kong and others who are competing in these sorts of areas. But Pauline may have a few things to say about wealth management.
It's a great question. There are three areas, I think. The first is in terms of regulation. Now, whether you like our regulation or not, the bottom line is we've learnt a lot, and we've learnt a lot about what works and what doesn't work and how regulation can drive different behaviours. And when you look at the unbundling and the unwinding of a lot of the tightness of the Asian financial systems, they want growth in that area. They want to provide financial services and more choice to their constituents. So there's a lot more conversations around, well, how can we develop our financial system? How can we have the robustness and the prudential supervision, but as well as get the consumer protection right? Because with the growing middle class, they are more sophisticated. They've got more money to spend, but then they've got more money to lose as well. The second is in terms of education, and Australia already does a lot in terms of education. In the superannuation space, that whole long-term investing fiduciary is absolutely vital and growing. The third is the funds management. Now, Super in particular has been investing in Asia and across the world for quite some time. I think we've built more roads in Asia and bridges than we have in Australia, because bigger population, 24/7, so their peak hour is not 3 hours like we have here. So a good proposition. But what superannuation funds are looking for, and therefore the funds management industry, is how do we get more diversity in our portfolios? When you look at Australian industry, whether it's right or wrong, there's a lot of gaps in what industries we have, and ultimately diversity is in the types of industry you're invested in. So when you look at the IT industry, the health industry that's coming out of a lot of our Asian neighbours, they are enormous opportunities for us. How we get the governance right on that, how we ensure their markets are right, so their exchanges allow us to invest safely with limited risk is still a challenge, but certainly it is a growing conversation.
One of the guiding principles of superannuation is that the funds are invested for the benefit of the members, and that's a principle that you don't want to mess around with, and I think all three of us would agree with that. And I think the other thing to draw attention to, there is a kind of the idea that we're generating all these savings and we're not, and some of them are being invested offshore. Remember the aggregate picture. In aggregate, the Australian economy invests more than it saves, and it has for almost ever. Ever's a long time, so let me not be quite so... but nevertheless, one of the defining features of the Australian macroeconomy is that we invest more than we save as a society, and we save a lot. We're now one of the highest saving countries of the advanced rich world, but our investment levels are even higher. So the difference is, of course, the current account deficit, and we are borrowing in broad terms from the rest of the world to invest here. So if it was I'm all in favour of getting rid of regulations that impede the capacity of superannuation funds to invest in infrastructure domestically. If there are inappropriate regulations stopping that, then let's get rid of them. But to imagine that as a consequence of that, the gross amount of investment that Australia ends up doing will be higher, I suspect is not true. There will be other flows that will compensate for that. We already invest extraordinarily high levels broadly speaking, in the domestic economy, and I suspect those levels will not go up from here, given that what we're about to see is a retracement in investment in the resources sector from something close to 8% of GDP back to something like 2 or 3 over the next 3 or 4 years. So all in favour of doing away with regulations that are impeding the capacity of people to make profit maximising decisions that they ought to be making, but don't imagine that there's some sort of drought in investment, broadly speaking, in Australia. The opposite is the case.
Look, I think there's a couple of things I can add to what David has said. The first is that the nature of Australian superannuation is that we have a real need to be liquid, and liquid as much as possible. And the main reason for that is that people have choice. So they can get their money within 30 days. And as you saw from my slides, they exercise it, and they exercise it big time. A lot of other funds, particularly the Canadian DB funds, they're defined benefits. They've got the money for 20, 30, 40 years. They know exactly when they have to pay out and how much they need to pay out. So their ability to invest in a different way is there. Now, that opportunity will increase as we move more into drawdown, but it depends on how the system is designed. Stephen talked about we need flexibility, and we do. People want to know, they want 3 things in retirement. I want to know how much I'm going to get each week. I want to know that if I die early, I don't do all my capital. And I want access to lump sums or be able to convert my income streams to lump sum if I really need the cash, and particularly as I become frail and need to go into aged care. So how do we build a system that allows that but doesn't mean we have to keep on investing short term to really meet those liquidity needs? That's why it's not an easy conversation. In terms of impediments, there's a number of impediments. We've written loads of things about infrastructure, the bid process. We've finally got an investable pipeline, but the bid process in Australia is expensive and complicated. If we do $20 million doing a bid for a piece of infrastructure, we've got nothing to apply that loss against. So we have to be very careful how we do it. In terms of fixed interest, the market isn't there, and it won't be for quite some time. The area that I think we can do a little bit more on is in terms of the ASX. You mentioned innovation. There's a lot of small companies that are moving onto the lower half of the ASX that really are about future innovation and managing climate change and all of those risks. There's little transparency and there's little visibility of their risk return profile. And I know the ASX is looking at this, but that's an area, the more we can get visibility around that lower half of the ASX, the more funds will invest in the whole market, not just the top 200.
2 things. Look, I love being able to say this. I've been in my role 4.5 years, and no bank has ever asked me in that time to do anything about 4 pillars. I'm sure they've got their views, but it's just not on the agenda. Will it disappear through trade negotiations? The only intelligent thing I saw written about it was, and I don't think this is contingent anyway on trade negotiations, but in terms of 4 pillars, the only time it's going to become an interesting issue, I think, really, is if a foreign bank makes a bid for one of our major banks. Now, at the moment, it's highly unlikely because our banks are very highly priced. Part of that, even more so now, but part of that sort of a flight to certainty and stability in our banks. But should a foreign bank make a bid for one of our major banks, then it raises a legitimate question as to why can't an Australian bank also bid for it. But in the absence of that happening, I don't think 4 pillars is going anywhere anytime soon. On the broader issue of, oh dear, shock horror, trade negotiations are going to water down financial regulations, it fails to take into account that pretty much all financial regulations now, particularly in terms of the stability of the system, are set at a global level. So, you know, it's one of the things, it actually raises, for me, a more interesting point, and that is that as financial regulation is increasingly becoming globalised, it was happening before the GFC, it was accelerated by the response to the GFC. How does a small nation like Australia actually manage in that sort of circumstances? Because we have, you know, a country that is in many fundamental ways different from our European or US counterparts, who often dominate a lot of these negotiations, and yet we can't opt out of the global regulatory process. So there is another challenge there for the Financial System Inquiry and for Treasury and others. But the chances of us watering down our financial regulations just for some sort of trade advantage, can't see it happening.
There was no doubt that, on one view, if funds are measured short-term, it drives short-term performance of its fund managers, and that drives short-term performance of the listed entities, because that's where the money is. That is not good. That is not good. So we're starting to see, I think, more science around the long-term performance of listed entities. So remember, you couldn't really do it before. There wasn't a matrix to do that. So when you can start measuring the potential for long-term, then that starts to drive a much more exciting story. And we've been saying for quite some time, you know, we've got to look at what is short-term. Our biggest concern at the moment is that there's so much data going to be flooding onto our screens in terms of every single nook and cranny of the superannuation industry. Our data collection has gone from 300 for 3,000 pieces of data. So that's going to toss up all sorts of things, and I think that will reinforce a lot of the short term. But it goes back to what I was saying in terms of how we should change the performance measures. If we really are about long-term income streams, then and again, there's a lot more science around this. Have we nailed it yet? No, but we're getting much closer. So what do we need to do? We need to invest for the individual goals in retirement. If you really do that properly, then you need to take into account their whole wealth situation. How does that then translate to how you invest? And we're starting to see glide paths, age-based investing, lifestyle investing, which is the journey towards that. Then when you get there, it's not how much you've got, but what is the capability and the likelihood and the amount that entity will provide an income stream. Because if you've got 100 grand, you can have a very different outcome over 20, 30 years from one provider to the other. Depends on the product, it depends on the investment. That will change to long-term investing, and that's the measure that we've got to develop soon.
I think the aim is to make as much progress as possible by November on the four issues that I talked about. But I would agree with you that it's unlikely that we're going to see the kind of completion of all the relevant work. There's a live question about for how long you keep up this, what might be called frenzy of activity in financial regulation at a global level. A lot's been achieved, and I think there are genuine disagreements about how much more you want to do. To some extent, it goes back to Stephen's point that technology is continually throwing up new challenges. You'd have to say that the state of financial regulation before the global financial crisis was woefully inadequate, despite the fact that the major players were not aware of the fact that it was woefully inadequate, which is a pretty sad state of affairs. You can go back and read all sorts of glowing statements from the IMF or some of the major regulators about just how stable the global financial system was because it had diversified risk. As we discovered, it had diversified risk largely to the people who didn't understand it rather than to the people who could most bear it. So It's a genuine and difficult challenge for regulators to be aware of where the risks lie, and I think it's going to be an ongoing challenge to make sure that we do understand the implications of new innovation. After all, remember, shadow banking, securitization, all sorts of these things were major innovations which turned out to be flawed. I'm not against securitization, but it was very clear that the originate to distribute model was designed in a way that had fatal flaws in it before the global financial crisis. So the general point I'm making is it's a genuinely difficult question to keep up with the innovations that are happening and to have, if you like, fit-for-purpose regulation rather than to close everything down. It's not like we want to stop people taking risks. We simply want the implications of those risks to be to come back to the people who are taking them, not to others.
Just adding very quickly to that, I mean, it's as David has said, it's about the pace of change as well. But the other thing I'd add in is, it is now an opportune time to actually stop and pause and actually assess the impact of what we've already done, rather than continue to innovate in terms of coming up with new areas to regulate.